The automotive industry has been subjected to significant transformations in recent years. These alterations have extended far beyond the design and manufacturing of vehicles and have considerably impacted how automakers conduct business and how car dealerships operate. A large proportion of these changes has been influenced by the current economic conditions, technological advancements, and shifts in consumer behavior. Among these changes, the most notable shift has been in the dynamics of car prices. This article aims to shed light on these shifting dynamics and explore the strategic approaches adopted by automakers in pricing, especially with a focus on the reduction of dealer margins. Traditionally, automakers had a specific arrangement with car dealers, allowing them to mark up cars by approximately 5 to 10%. This figure represented the difference between the dealer cost, that is, what the dealer paid for the car, and the manufacturer's suggested retail price, MSRP. The markup allowed dealers to generate a reasonable profit from vehicle sales and also provided them with a margin to offer discounts to attract customers. In response to the pandemic and the resultant changing market dynamics, automakers have significantly reduced these margins. The circumstances have compelled automakers to reconsider their cost structures and pricing strategies. As a result, most vehicles now have a markup of only around 5%, with some electric cars being sold to dealerships at zero markup or even at a net loss. This radical strategy is primarily being adopted to promote the sales of electric vehicles, which are still relatively new in the market. This decrease in dealer margins has inevitably created challenges for dealerships. Traditionally, a considerable portion of a dealership's profits came from the markup on vehicle sales, but with reduced margins, it has become increasingly difficult for them to make profits solely from this avenue. To compensate for these reduced margins, dealerships are adopting different strategies. They are increasingly relying on marking up used cars or selling additional products such as warranties, accessories, and after-sales services. This new strategy has its drawbacks. The lack of significant markups on new vehicles restricts dealers' flexibility in pricing. They no longer have the option to offer large discounts to attract customers or to compete with other dealerships. This scenario has resulted in elevated prices for consumers, limiting their options and potentially creating a barrier to new vehicle purchases. A concerning aspect of this situation is the contradictory message being sent out by automakers. On one hand, they are publicly advocating for customer-centric pricing and transparency. They are positioning themselves as champions of the consumers, emphasizing the importance of reasonable pricing and easy access to vehicles. On the other hand, behind closed doors, they are urging dealers to find alternative ways to generate profits. This means finding ways to supplement their income that may not always be in the best interest of the consumers. This discrepancy between public messages and private advice has raised concerns among industry observers. It poses a serious dilemma for dealerships, forcing them to walk a tightrope between the expectations of automakers and the needs of their customers. It also challenges the notion of a uniform and customer-centric automotive industry. Rather, it paints a picture of an industry that is evolving and adapting to new challenges, but one that also needs to address the discrepancies between its words and actions. The current discourse surrounding the high prices in certain economic sectors tends to overlook the tangible evidence of declining car prices. Recent investigative reports are coming forward with data that strongly indicates that the value of vehicles, particularly used cars, has experienced a substantial downfall over the preceding months. A crucial indicator of this depreciation is the increasing used car loan-to-value ratios, a financial term that signifies that the loan balances of the borrowers have now surpassed the actual cash values of the cars. This downward trend in prices primarily unfolded during the autumn season, which subsequently led to an immense surge in buying during the spring of 2023. This buying frenzy was fueled by the falling car prices, which, while financially beneficial to potential car buyers, came with its own set of repercussions. An illustrative instance of this trend can be seen in the increased used car loan-to-value ratios, which rose to 125 in the first quarter of 2023 from a previously recorded figure of 104 for the same time in 2021. Essentially, This means that the debt amount for car owners has reached 125% of the car's actual cash value, which not only highlights the significant decline in the value of the vehicles, but also emphasizes the growing financial burden for the borrowers. As a direct consequence of the decline in vehicle prices, negative equity has emerged as a substantial issue. Negative equity arises when the debt on an asset, in this case a car, surpasses its market value. This problematic situation has been on the rise in recent years, trapping some consumers in a state where they owe thousands of dollars more than what their cars are actually worth. This can inadvertently lead to higher rates of loan delinquency, increasing the financial strain on car owners. Indeed, recent data indicates that the negative equity figures have outstripped those observed during the peak of the recession period in 2009 to 2010. Consumers are entering into auto loans that exceed the market value of their cars, with some grappling with negative equity amounts of approximately $10,000. This situation can escalate into a severe financial burden when these car owners attempt to trade out of a vehicle that has a substantial amount of negative equity, often finding that there are no straightforward solutions. The car market pricing volatility is significantly shaped by a host of external and internal factors, encompassing aspects such as the availability of car inventory, manufacturer incentives, dealer discounts, and the values attributed to trade-ins. Additionally, more disruptive factors such as the microchip shortage have also played pivotal roles. This shortage led to major setbacks in car production, bringing about a significant impact on inventory levels, and subsequently causing a ripple effect that destabilized the supply chain dynamics within the automotive industry. Inventory levels are not static and display significant variation across the range of car manufacturers. For example, consider Toyota, which at present holds an inventory supply amounting to between 20 and 30 days. This figure stands in stark contrast to Jeep, with its supply stretching over 150 days. These sizable disparities in inventory management undeniably impact the pricing strategies set by manufacturers, while also influencing the scope and availability of incentives that can be offered to prospective buyers. As a further case in point, Ram trucks currently have an inventory supply that surpasses 110 days, thus enabling the brand to provide the most substantial incentives among all trucks in the market. The automotive industry is currently in the throes of a significant transformation, characterized by automakers decisively cutting dealer margins. This bold strategic maneuver has the potential to lead to lower car prices for consumers. However, while this change may initially seem beneficial to buyers, it also presents its own set of challenges. The reduced profitability for dealerships curtails their ability to extend considerable discounts to consumers, leading to a more complex market dynamic. This has also exacerbated the issue of negative equity, a situation which is becoming increasingly prevalent. In this scenario, car buyers find themselves in a financial quandary, wrestling with the repercussions of inflated prices and extended financing deals. For consumers, gaining a thorough understanding of these market trends and dynamics is crucial. It equips them with the necessary knowledge to effectively navigate the intricate car buying process, empowering them to make informed decisions that are in sync with their financial standing and objectives. Despite the existing hurdles, the current market landscape does offer opportunities. Consumers can capitalize on the falling prices, but it is vital to be cognizant of the looming risk of negative equity. It's a balancing act, with astute awareness and decision-making playing a critical role.